Right now, let's check in with Glenn Wiggle of the Financial Guys as the stock market taking another tumble today. The Dow down 801 points as we approach the close. And Glenn, what caused the losses today?
Well, today we have an inverted yield curve as the latest market jitters, continue. So, last week we had a lot of volatility regarding the China trade deals and Trump adding tariffs. This week today the yield curve went negative. So the long-term rates are now lower than the short-term rates. That typically in the past has been a pretty good sign of an impending recession. However, in this case, there are other issues that are playing a factor, such as international markets being very weak, international economies being very weak. And I think that's also playing a factor here. So I don't think that in this case, I happen to agree with Janet Yellen that the inverted yield curve in this case may be a false recession signal.
What exactly is an inversion of the yield curve for those not familiar?
Well, it means that the long-term rates on the things like the 10 or the 30-year Treasury bill dip below the short-term rate. So early this morning, the 10-year Treasury note dipped down to about 1.62 on the yield, and that was below the 2-year Treasury yield at 1.63. So it means that if you're a bond investor, you can buy a short-term government bond, let's say a 2-year Treasury bond, at a better yield than a 10-year Treasury note. And so the yield curve is kind of upside down. Normally, you get paid the longer you hold a bond. So in a normal situation, you'd have long-term interest rates higher than short-term interest rates. But in this case, just the opposite, which means it's an inversion of the yield curve.
All right. Glenn, thank you very much. That's Glenn Wiggle of the Financial Guys.